Alright, let's talk about one number every investor hears about, but few truly understand: the Sharpe ratio. Sure, everyone says it's the gold standard for measuring risk-adjusted returns, but is it really that simple? Not quite. Here's the deal. The Sharpe ratio basically tells you how much extra return you're getting for the risk you're taking. You calculate it by subtracting the risk-free rate, think T-bills, from your portfolio's return, and then dividing by its standard deviation, which is just a fancy way to say volatility. Sounds smart, right? But here's the catch. Not all Sharpe ratios are created equal. Professor Adam Reed's recent research shows that this ratio can actually be manipulated, sometimes by smoothing returns or cherry-picking data. This is especially true in hedge funds and private equity, where reporting standards aren't always crystal clear. So, seeing a sky-high Sharpe ratio, it might not be telling the full story. That's why institutions are getting clever. They're adjusting for things like fat tails, those rare but nasty market shocks. They use advanced stats, rolling windows, even machine learning to get a more accurate read. And they're demanding more transparency. No more guesswork on how the numbers are cooked up. At the end of the day, the Sharpe ratio is still a magnet for investor money, but the real pros know it's just one piece of the puzzle. If you want the full picture, look at metrics like the Sortino or Omega ratio too. So next time you see a fund bragging about its Sharpe, dig deeper, because the truth is often hiding in the fine print.